Good afternoon. My name is Scott Redler, Chief Strategic Officer at T3Live.com. Welcome to today's recap. So if you turn on the TV, you definitely see that today was a pretty sizable down day, a trend down day with pretty much everything, closing near lows. So the question is, how could you have seen this? How could you have been prepared? Everyone was just saying we're about to go to new highs. It's rally on. The way you participate in the market is by watching the trend that you trade. Now, if you look here at the chart of the SPX, you will see that, we've talked about this chart into a blue in the face. Face. Anyway, it's been a long week already. Here was your August low. Here was your double bottom late September. This is when it cleared the lower pivot, confirming the double bottom. Okay, and then what happened after that? You had a trend, a very, very strong trend. Okay, I'm going to say very, very because for a very long time, it did not violate the 8-day moving average. This is when it went above. Okay, and remember when it broke above this resistance, gave you a quick push. What did it do? It held the 8-day moving average. Then you had another push. Came up, pulled in, held the moving average, the 8-day right there, and then all the way up to right here. This is the first time you had a decisive break below the 8-day moving average. So, not everyone uses the 8-day moving average because not everyone trades for alpha, for active cash flow, follows accelerated trends. People think they could play the bigger picture and it doesn't matter to them using technicals. They held through the big move in August on the way down and they made all their money back on the way up. But for us, we don't do that. We need to be kind of right every day to put together a P&L. So if you go back to the chart of the SPX, you will see right here is when you had to say, okay, I'm going to take risk down. If you happen to have been riding the trend, which probably a lot of people probably stopped doing right around here. I know for me, every time, on this was my first time trying to be net short and then got out and got long again as I got stopped out here. On this one, I don't think many people tried it, but then here, I think I went out net short again before that. And then in here, finally, the, little red dog to or whatever it was called, something to shotgun to head. We see 207 before we see 2000, 2130 before 2007. Anyway, whatever. This is where we closed below, and that was your, let's wait and see and get tactical. Then you had a little bit of a reversal, okay, on Tuesday. This is when a lot of us went home long, thinking, okay, 1, 2, 3, 4 days down, let's get long. And then yesterday, it reversed. It did not hold up. It did not reclaim the 8-day. The 8-day became a rejection point, and then today happened. So that is how you measure an active trend. That doesn't mean this whole entire thing goes to waste. What it means is, if you've been riding it, this is your out. And if you were looking for your first signal to make some cute cash flow, you had it here. And then you could have even sold the rally there. And now here's where we, closed today. So, yeah, I have no idea what's going to happen tomorrow if we gap up, gap down. All you know is this spot for now, which is today's low, 2,045. Then you have another level right in here, which is around 2,035. And then, if you remember, this is where we had that little peak. Remember that little topping tail? And then this is also where we broke out from. So you draw this across. So, here is your next zone. If you're playing zone defense, so to speak, this 2,035 down to 220. If we see this tomorrow, I would think that we can get a buyable bounce, and that would be great. Maybe we open lower, get a pivot like this to close, and then we see, the next time we sort of rally, can we reclaim the 8-day or does it get rejected? Because now we're below the 8 and the 21-day. So those of you who said, what, I'm not going to be so tight. So many times if I would have, sold it when it looked like it was going to break the 8-day, I would have been out. Instead, I give it to the 21-day. I'm a bigger picture guy. And then boom, here was your out. Right there, okay? Maybe you got long when it reclaimed both around 1960, so you didn't sell 2020. You sold when the market broke below 2068, which was your weekly low pivot. So anyway, this is the spot we're looking at tomorrow. If we gap up, we'll see if it can hold. Maybe it trades below today's low and puts in a red dog reversal. Or if we gap lower, maybe it comes back up. The oscillator right now is finally oversold again. Where I think we went out of minus 40. Anywhere above minus 40, it's hard to be short. So if you just shorted today on the close, you better be careful or minus 40. If you've been short since we broke the 8-day, maybe you covered some on the close and you still stay short a little bit overnight. So as far as other sectors, nothing else was leading really besides tech. You had the Russell have a catch-up play, the bios have a catch-up play, the oil a decent counter trend trade. So you had to basically measure each one of them pretty closely, because when the music's over, they turn out the lights. Anyone know what that's from? If you tweet me, I'll give you a 2-week free to Redler All Access. Anyway, that was a little cheesy. Let's go to the IBB. The IBBs, which have been, somewhat of a leading indicator, giving you some clues of things, bound to happen, broke its trend right here. And then remember the head and shoulders top right there, and then the extending, channel break right there. Well, you had a decent rally. This was a nice lower level pivot to trade above 317, came into the prior breakdown area and reversed. Then actually we talked in the morning call about this little, short-term head and shoulders pattern, this little micro one, where you had, this being the neckline around 320. This was 340. So you flip that over. That's 20 points. It broke this below. 20 points from 320 gets you down to, this right back actually down to here. And this I don't think was a real print. Otherwise, it would have fulfilled the measured move of this already. I think it closed around 320. It was $1 lower. So, that's not for real. But tomorrow, maybe see if this holds, which is a prior level here, which is 316-ish. So right now the bios gave you a good swing long, and then basically, broke the, the moving average there, came up, and, here was your outside day to, get out if you didn't get out already, and, then there's your downside follow through. The Russell, not really doing much either, except for, we had a decent trade, here when it took out this range, and remember that little cute pullback, and then it went, and then, this broke basically yesterday. Here was your first wide range red bar, and then no downside follow through, and then yesterday, this closed below both moving averages and below that spot, so it was a good spot to reduce risk. And then today, they took out its accelerated trend pretty fast, so you had to be real quick, and now it's basically right back in that range, not really, not really telling you much, except for, you had a counter trend rally. It traded through the 200-day briefly and now lost it. So I guess, next spot, if it wants to, come down to, is right around here. And what you do know for tomorrow, if we get a red dog reversal, because we're a bit oversold, today's low is 114.73. So if it opened below it, maybe you buy it for a cute bounce. If it opens above it, pushes below, it comes back, the drill. And here is, the support that held pretty firmly. But overall, look, if you look in hindsight, which is always 20/20, what did it do? It came back up and retested where it broke down from. So, not much to go on except for, cash flow is cash flow, and if you trade actively, there were some pivots to work with, and now, who knows here? It came down pretty fast. So we'll see what's next. The banks got hit a little bit today. Gave back. We talked about whether or not there was an exciting gap or a gap fill or a gap in crap. So many people call it so many different things after the hot jobs number. If the banks were going to be great, it should never have gave back this gap. Not only did it give it back the day after, and then a lower high, and now this accelerated trend is in jeopardy. So that's how you look at things. Goldman Sachs. There you go. There's your upper flag type pattern. If you were trading versus this, in my note I go, if this holds, then it's still in the game for that. If this holds, it's not. So what was that? That price was 196.73. If you were long Goldman Sachs, that was your stop. And now this too, we'll see what happens next. But I guess we'll see if this holds tomorrow. But overall, upper levels do break. And ascending channels do break. And it's always good to know, levels to use as stops if you're uncommitted. Listen, if you're in it from here, or you're in it from earnings day, then this might not mean anything to you. But if you trade for alpha and you were hoping to maybe get a move above this and continue, this took it off the table, and now you have to figure out if we hold the 21-day there. You could probably look at every bank, looks just the same. JP Morgan, it basically gapped up, after that hot jobs number. The next day came below the prior low. So if it was like earnings, it would have been the same thing. Is this an exhaustion gap? So boom, lower high, and now it's coming back into pretty much where it somewhat broke out from. So maybe we'll see if there's a viable bounce here or not. But this is below the 8-day, and the open up and sell down yesterday gave you clues that you got to be very, very careful there. And listen, there's always clues in everything. Today I came in, I was like, Netflix looks great. If the market holds in today and reverses and we need some leaders, Netflix could break above 114.60, 115 and, perhaps give us a momentum trade. But a momentum trade is only a momentum trade if the momentum sticks. If you look at Netflix, it went from looking great to looking horrendous. Okay, not horrendous, but it went from potentially being in the game to take this level out, okay, and show some momentum to a basic red dog reversal where it pushed above 114.60 when the market was bouncing, went to 115 and failed. Okay, so I was in Netflix and I bought more at 115 and then I got stopped out at like 114 and they got stopped out when it broke below yesterday's low because it should not have done that if it's going to be strong, and that was at 111.41 or somewhere around there. And if you did so, you know what, you didn't have to sit around for it to close down here at 108. So hopefully on that move, you got out of your Netflix, especially if you were playing it for a potential move above resistance. Now you have a small red dog reversal. I'm not saying we're going to fall apart, but it's not breaking out above 115 anytime soon, and that was the play. Be in a tier 1, be in a tier 2, sell at 120, high fives. No, it failed. Okay? If you were in it from this little spot when it took out this little lower pivot, and you're like, I'm going to give it more room, okay, then you're giving it more room, and you'll see what's next here. So we'll see what kind of follow through happens tomorrow. If it just goes up tomorrow and then hangs in and then hangs in again, then it'll repair itself and then maybe it can go again. But for this candle right here, that's your get out of Dodge, especially if you added for a breakout. No breakout there. Amazon, what did you do? Not the end of the world, but if the market does come in, maybe some money leaves this. This is your first green bar matched by a red, but it's again extended from the 8-day. It's been safer to buy it when it hit the 8-day here and here versus extended, and markets start to pull in a lot. Some fear comes to even the best ones. So at this point, I guess it's still in this trend. So don't be so cute and press shorts. But if you saw the market turn tail today, maybe you caught a cute trade in in this Amazon. There really wasn't much of a signal to do so. This was yesterday. This is today. Just a grindy. So really nothing, telling you to just be short there. But again, when markets start to close and they're dead lows down 200 and change, that's all you get from Amazon. And look how elevated that is too. So you just better be careful if you're just buying any kind of dip, because if this breaks, here's your 21-day down there. Okay, and strong stocks do pull back to their 21-day also, especially if markets start going a heck of a lot below that. So just be careful if you're riding that trend. Google, let's see what you did today. Hold on. Google, a little weaker than Amazon. It already actually opened up and then went below yesterday's low and closed below it. So I would have, if you were in this as a swing trader, been out. Some might even test this short, and if it were to break the 8-day, that too would probably add pressure to the overall market, because then the next level underneath it is the 21-day, and then it's still well above the gap from earnings. So, got to be careful. Last time, what happened when the market fell apart in August was it started to break down on that Thursday, and then on the Friday, high beta tech played crazy catch up to the downside, and that's what led to the follow down weakness, on Friday into the Monday. So you want to see what happens here with these leaders. Do they still hold in there, or do they, does the pickle drop out of the pickle jar and then boom, that'll take us lower in the S&P and make things even more volatile. Facebook was a good trade today. Went back and forth here and there, but it too, if the market gets vulnerable, it could pull in. So I remember what happened was it was right here, where let's go into here for a second. Okay, I remember because right around here when the stock looked really good. Not saying it's going to happen again, okay, looked fine. Was flagging, going sideways, looked as if, it was going to be okay, holding in there. The moving averages converged, and then boom. That was I think that was either Thursday, and then that was Friday, or this was Thursday, and then this was Friday. And then obviously the flash crash happened on Monday, or whatever you want to call it. And so fast forward to where we are now. Not saying this is going to happen again, but if all of a sudden, Facebook loses the 8-day moving average, you got to be careful that, the juice could come a little loose and it could at least test here, or maybe even test a 21-day, which is still deemed strong. So just be a little careful if you're just buying dips, which have been working. We had a nice red dog reversal here when the market was still, near high, so it needed leadership, and now, it's flagging again. But if this were to break, chances are we go down further in the market. If it holds up here, then perhaps, the downside gets contained. Let's hope that it holds above here, or we'll see. So I'm just trying to, throw out some if-thens there. Apple, gap down on Tuesday. It's been trickling lower. It hasn't been falling apart, but that big hole in the chart is definitely not good to see for the bulls. Apple, last time it had a big gap down, it was after earnings right here. It never filled the gap and then had this bear flag, and then boom. Okay, here, remember we played this nice little rally on this spot. I played it after earnings. This was that nice trade above 119.20. I did sell some here, and I've been testing some levels, but I was not long into here because it was vulnerable. And now you have this big hole in the chart. So when there's a big hole in the chart, that means the professionals don't think it's, no one thinks it's cheap, right? If it closed here at 120 and opens down to 117, there's $3 worth of people not having the chance to buy it. So if it comes here and doesn't fill it, that means they don't want it there. So until someone shows that they want it, this could come all the way into here before, I guess, there's, some bigger support. But at this point, the longer this stays open, the more this is in the penalty box, and you have to just take your tactical trades or trade it less. But overall, this gap down was a little bit of another, chop at the leg of the bull, and there's nothing you can do about it. We'll see. Maybe some Apple comes out and says, no, that's not true, that they're ordered 10% less component parts for all their products, and fourth quarter looks awesome, or the Christmas season. Then maybe it rips, and then you get a few leaders back. But right now, leaders are very narrow and they're far and few between. Oil, we talked about how comfortable it was between 44 and 49, and that if it broke below 44, the market would care, because then your next spot could be 40 or 38 lows. We talk about the USOs. So the USOs, they started to make another move lower, and it started way before today. Okay, basically your shot across the bow with this was right here when it broke out and engulfed it this day. If you were long oil because of this inside move, thinking it can go back to highs here, okay, that inside day got you out, or that outside day, I'm sorry, where it opened up and closed below this low. That was it. And then we talked about the importance of this spot, because a trade and close below gives an open window back down to the lows, which is not what oil stocks are going to like, and that's not what the emerging markets are going to like. That means the dollar is very strong too. So this move down in oil continued from right here. Remember this one? You had this flag, boom, that led to moves to the lows, and now here you are. And the XLE, which I tried a few times to buy, I got stopped out of, doesn't look so hot. Okay, I don't know if it needs to fill this gap first, but remember this engulfing move right here, came up, came down. We were watching this little flag pattern that broke below, and then you had your gap down that led to another move. Well, I thought maybe that was what this would be, and at this point, it's not. It's a big gap down, and we'll see if it gets filled soon. But this trend is down again, and here we are coming back into bigger support, and this is a broken sector. I just want to show you something, guys. My rule is this: as an active trader, when the 8 and 21 day get broken, you get out of your swings. Just so you know, the 8 and 21 day broke right here. This was at 96. This is when your head and shoulders top came in. Your left shoulder, your head, your right shoulder. And then here is when it broke. And this is when it lost a 200 day. When sectors lose their 200 day and stay below for multiple days or sessions, that means it's uninvestable besides just not even a trade. Then obviously you've had, well, if you're out of it, you have tactical moves along the way. Came back here, it failed, did its double bottom with the market, and now all it's really done is come back up, retested 200 day, and came back in. So that's how you stay away, as far as investment-wise, trends that are below the 200 day, and obviously as active traders, we're well away from it by the 21 day. So there's always rules to follow. You just have to figure out which ones you want to adapt for your process. So in closing, a lot of the commodity stocks that have been weaker got really weak and got downside follow through. The leadership that has been very narrow is getting more narrow. We had a 12-13% move in the S&P that has now retraced, a little bit. So let's just show you, real quickly what the retracement is here, just to, to see that it's not dead out of the woods. But at this point, we could see at least this in the spiders, right? And still, people were, how could this happen? What do you mean, how could this happen? Look at the size of the move that we had here from the lows. The low, the double bottom, the engulfing, the big gap up that held. above the 8-day, and then look when the spiders broke the 8-day, right there. That was your out. First time the spiders broke the 8-day during this entire trend. You're out, maybe get short, and then even if you missed this short and this gap down, close lower, that was your short. So now we'll see what happens into here. This pivot point is 202.89, and this one of the 200 days is right here at 203.83. So we'll see what happens tomorrow. Maybe if we get a gap down to the 203.50s, I think you could try and buy it. But just know that the accelerated trend broke, and we'll see what happens. Everyone was correlating this to, just say 2011. So I just want to show you something in 2011. Let's get there, because I remember it very well. I do it in my presentations all the time. Let's see if I could actually get it up here. Okay. This was, I remember this really well. This was that move. Let me do one more time. Bear with me. If you're still with me, bear with me. Okay, here is that 2011 move, right? Boom. Okay. Outside day, go over it all the time. Quick move up, took out the descending channel, went back to old levels, came in. So in the month of November, I remember this wedge. This broke to the downside. Okay, wedged. Everyone thought this one was going to go to the upside, went to the downside, came all the way back to here. Before, in the 2 weeks of December, boom, 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 boom. So I remember it knocked the teeth out of everyone. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, until everybody was just besides themselves. And then it gapped up and then gave you a big move to close the year around here. And then I remember this overall wedge, to start the year in 2012, then led to a nice, look at that, a move above the 8 and 21 day until finally it broke in the first quarter. So anyway, here was your move back up. Everyone got all bullish and crazy, and then came back in and then closed the year somewhere around that spot. So if you fast forward to where we are now, I'm not saying it's going to happen exactly the same way, but you just don't. That's why people don't want to be caught buying too early. You buy too early, you buy here, you're probably puking it out there. So with that being in mind, you want to test levels, be a little tactical, and when it finally turns again, you get a gap up that holds with some volume, you go with it. Because, in here it was fast and furious, it was hard to be long, but it was the only time that the long worked. So now you're trying to buy a dip and the long's not working. So, just, it is what it is. It's Thursday. I hope you had a decent week. There were definitely some signals early in the week to take some risk down, be tactical, and even if you did so, you probably lost some money. I know today I lost some money trying to, buy, in the first hour versus the low, and went to Bloomberg, had 4 positions on, and by the time I came back from Bloomberg, I was stopped out of everything. And, even if you're tight, 4 positions, you lose money. It is what it is. But I missed the whole downside follow through the last hour, so it could have been worse. And now if we open up down tomorrow, there's another opportunity to come in fresh versus being stuck. And if we open up 15 handles tomorrow and you have no risk on, you can't be upset because you don't have the risk on to be involved. So we'll see what happens tomorrow. There's still a lot of action in front of us. We still have, 6 weeks left in the year. There'll be opportunities there, but if you start doing things too early and you get frustrated and you get frazzled and you start yelling at the keyboard, breaking screens, kicking the dog, chances are you're not going to make money. Or you're just a bad person. Or it is what it is. You're too emotional. But we could all work on that. With that said, have a good night. I'm in Short Hills tomorrow. Rob in the Black or Dave Green will probably be doing the morning call, but I will try and tweet, and you could probably catch me on the VTF from there. Just no videos until Monday. Good night.